So the idea is we're expecting where the market is now to trade down to this level, and then a reaction should ensue. Now, your choice as a trader is, if we're here and you think it's going down here, to set up a move to go later higher. You can be a trader from this point here down, or wait till it gets to this level and then try to trade the bounce. Now, let this image burn in, so that way when we transition to the market maker buy model, it's this idea we have in mind here, okay? Now, these lows can form two different ways. You can start by coming down, come off that short-term low, and then make a lower low, creating the ultimate low in this price swing here, and then price running higher. This sets up a ICT breaker, where we have a low, high, lower low. Once it breaks that short-term high in the middle, if it trades back down into that, we could be a buyer somewhere over here to capture another continuation on the upside. Conversely, there is another formation you can see where it trades down, comes off the low, and turns with a higher low and starts to trade higher. This one here, I like to see this form only if there is a SMT divergence. And what do I mean by that? Well, let's assume that this is the euro dollar, and I expect the euro dollar to trade from its market price down to a key low and then trade higher. At this low, if I see euro making the low and then a higher low, at the same time pound dollar is making a low and then a lower low, that's an SMT divergence. What this indicates is there's a strong disparity between what the algorithm is pricing in for one currency versus another. If we're expecting higher prices in euro, it goes without saying that we should reasonably expect pound dollar to rally as well, unless there's other factors that would negate that. But for the majority of the time, and a general rule of thumb, all foreign currencies should be rallying together and falling dollar seen with that instance. And that crack in correlation many times signifies a timing aspect that would be confirmation to expecting this level down here being significant or key that leads to an upward price swing later. Okay, with that idea in mind, usually the market will be in some measure of consolidation. I like to see some kind of a little short-term trading range, and it is very subjective, this part. Okay, what is a trading range or a consolidation? Where price is having several candles, not two, not three, not four, but it just stays in an area over a prolonged period of time. How much time, Michael? It's all relative to the time frame you're looking at. If you're looking at a 15-minute time frame, it could be, I don't know, maybe 10 candles or more. And I'm just giving you a rough idea because experience is going to guide you on how many candles really make up a consolidation. So from a modular standpoint, when I say that the market is usually in some kind of a short-term consolidation, it could be, consolidation on one time frame, but just simply 2 or 3 candles on another time frame that would be higher up. So it's all relative to what you're expecting in terms of the market price. If it's on a 5-minute chart, the consolidation may look a lot longer in terms of duration. Versus if you look at it from a 4-hour chart, it's all within one candle and you don't even see a consolidation. So the market will leave this consolidation, and inside this decline, we wait for another area of either retracement back to the original consolidation, which it does not have to do. So as the market drops down, I allow in my analysis the potential to return back to the original consolidation. But if it does, I need to see a very sharp rejection there. It can't just come back to the original consolidation low and then hang around for a little while. It needs to come back up there and then break. I like it even better if it tries to make an attempt to get back to the original consolidation low and fail to get there and then breaks hard. I really like that because that indicates a very heavy market and it's likely to continue going lower. But either or, the next short-term consolidation, and this doesn't usually last as long as the original consolidation up here. So what we're looking at is a consolidation, a market that breaks lower, that maybe trades up to here, and if it does, we'll look for a sharp decline. If it doesn't and just goes right into another area of consolidation, it usually will set up like an optimal trade entry. So in this area here, usually you're going to see an optimal trade entry short. It'll be a low retracement back up into a bearish order block and then slams lower. Or it could be a low short-term high and then a higher short-term high that runs out short-term buy stops. Then it sells off. So either one of those instances will allow for me to take a trade going short. Because remember, I'm waiting for some level down here I've indicated at the beginning of this discussion that I think it's going to trade down to. I'm just anticipating, whether I'm engaging or not, another price leg lower. And when it comes, should it come, we're waiting for some kind of expansion lower. And sometimes we'll get a secondary level of distribution, which will be another either optimal trade entry sell or a short-term high that's ran out with a higher short-term high and then leads to another level of lower prices until we get into that area where we expect that key level to be reached. This is where the market goes into smart money reversal. Okay, usually it will form the same way it is outlined in the price swing, where it'll create a low, a lower low, and then look for a breaker, or it goes low, higher low. And if it occurs like that, again, using the intermarket relationships I mentioned earlier, if it creates a low with a higher low versus one definitive low that takes out a previous short-term low, in other words, the diagram I outlined when it was just that big blue V, the little animations I put in at the low, those are the only two things that can happen. How they trade and form in price leads to what process you look for next. I'm not really interested in a market that will give me a dull, flat, blunt-ended low. I will avoid that. At all costs, I'll avoid that, because that means I'm going to have to wait, because we could be seeing just another level of distribution that leads to another break lower, and then I'll revisit the analysis at a later time. But if we see price trade higher, we're going to assume that the smart money has accumulated longs in here. They are not pushing price up when they go long, by the way. We're seeing price trade down to this level, and then it kind of like spends a little bit of time down here, not a lot, certainly nowhere near the length of time that the original consolidation looks like. Very short-term little consolidation, and the algorithm keeps price in that range. Okay, so it's a small little dealing range it works in, and then it'll reprice. If smart money traders do not buy, they miss that move. So they'll have to wait for a low risk buy. And that usually will happen over here in a small little consolidation, which will form in what? In the form of a optimal trade entry buy, or a low and then a short-term lower low that takes out buy stops and then rallies. Usually right before significant price advances higher, some little short-term lows taken out for stop raids, and they assume those positions. When the stops are taken, those sell stops flood the market with selling, so that way counterparties that understand what the algorithm is about to do with price sending it higher, they'll buy those sell stops and they'll be positioned for a rally higher. We would expect price to trade higher until we get to another level of accumulation. So what we've already seen here is consolidating and accumulation of shorts. Accumulate more shorts. Accumulate more shorts. In this area, you may only get one area of distribution, and then it trades down to the smart money reversal, where they distribute their shorts down here. So they're going to buy to sellers at a low price, and everything they assumed over here should be hopefully offloaded here. Some of it here and some of it here. So their heavy positions are entered here. Some of it's taken off in profit here. Some of it's taken off in profit here and here. Or they'll go short here, add more here, and dump it all off here. So there's two ways for them to engage price and work within this market maker buy model. The longs that they assume here, they may not get them all on, and they'll have to add more here and then add more here, because as price is rallying up, it's going to be targeting the original consolidation until it targets the buy stops above this relative equal high or consolidation. All those buy stops will be the target of all of this. So if you're ever looking at price and you think that it's going to trade lower to go higher, the original consolidation, aim there. It happens on all time frames, and it happens on buy and sells. It takes price down, then allows traders that know what to anticipate to onboard here. And then they take it in scalings here, and then finally the last bit of a run, it's in a hurry to get above here. And this is a complete market maker buy model. And elements that are over here have to agree with over here, and vice versa. Let's assume this is that area where we were looking for the buy stops, and this is where the old low was on the daily chart where the sell stops were. Look what we have here. The market's consolidating. It leaves the consolidation, but why doesn't it come back up here? It doesn't need to. So it's better for it not to do that. And we have what? We have the level of distribution here, because we have what? Optimal trade entry, sells off. Another level here, optimal trade entry, sells off. Trades below that old relative equal low on the daily chart. That's that blue level on the daily chart. Those sell stops are being absorbed here. The algorithm holds price in this little consolidation, allowing smart money to accumulate. Once it takes off here, they can't enter. They've already missed that opportunity. So they're going to have to wait for some new level of accumulation. We have a low, a high, optimal trade entry in here, rallies up. We have another level here from this low to this low. That's optimal trade entry, because they have a high, low, higher low, rally. Trades up, consolidates, rallies again, and then drops down, takes out that short-term low, and then accumulates and goes higher. We're looking at how price trades down into levels that take out short-term lows. Short-term lows were taken here, it rallies. Short-term low was here, it took it out, and then it rallies. Short-term low here, trades down below it, and then on FOMC right there, it wipes it out one more time and then rallies. Then it takes out this level here, and ultimately takes out all the buy stops above this relative equal high and or original consolidation. So this is a market maker buy model. Now, we're going to talk about SMT, smart money tool or smart money technique. When we are down below these relative equal lows on British pound, we're expecting price to accumulate those sell stops. But how do we know that that's really going on? How can we trust that? Well, bring in the dollar. The Dixie, DXY, is being overlaid on the pound dollar chart. You can see that the dollar index went a little bit higher than this short-term high there. At the same time, pound dollar was unable to go lower than its previous low. Now think, if the dollar is going higher, pound should be going lower. But if pound is going higher, dollar should be going lower, vice versa. But if you look for times when there should be a key level influencing price, this high with a higher high on dollar should have been seen with a low and a lower low on cable. But notice what's happening. This right here is how the algorithm tips off the traders that are in the know. We already know go below those relative equal lows that their sell stop down there is probably going to go down there, accumulate, and go higher. That's likely. But how do we really know and trust that's going to happen? The dollar index gives us the insight, the x-ray view, if you will, where it went high, higher high, low, failed, lower low. So it's telling the traders without really broadcasting it that, okay, cable's going to start going higher because it failed to make that lower low where the dollar made a higher high. So this is SMT divergence. SMT is not a timing tool, it's a confirmation tool. Okay, it confirms something that you were already expecting anyway.